Welcome and thank you for joining us today. It's the 4th of February 2025 and this is the latest in our updates for clients on key topics which may impact your investment portfolios. I'm privileged to have been invited down to our new friends Mattioli Woods' head office in Leicester, and I've managed to grab some time with the Managing Director of Client Investment Proposition, Dean Cheeseman. Welcome, Dean, and thank you
very much.
Dean is going to give us a little bit of time today sharing Mattioli Woods' thoughts on the markets, and I'm very excited to have Dean and his team supporting us in our endeavours to ensure a successful long-term outcome for clients. Dean, would you mind just spending a couple of minutes introducing you and your team to our clients?
Sure, and again, thank you so much indeed for the kind invitation. So Mattioli Woods, we are responsible for about 16 billion of assets under advice. I'm privileged to look after the investment team. We're a team of 10, and within that team, we are dedicated investment professionals looking at macro events, portfolio construction, risk, basically putting the solutions together for clients in order to deliver those outcomes to keep them on that trajectory as part of their financial plan.
Thank you, Dean. I think it's fair to say at Cullen Wealth we are extremely excited to have Dean and his team supporting us. They bring a breadth of experience and knowledge to the table that exceeds what we have managed to provide so far. Dean and his team are currently looking at our current investment advice and recommendations to see where, if possible, we can make any further enhancements, and over the coming months I will be sharing anything with you that we agree upon. So, without further ado, let's get into the main areas of discussion today. And I want to start, Dean, with America. I think, over the last 10 plus years, America has been the most influential and dominant country in moulding investment portfolio behaviour. And of course now we find ourselves in a situation where there is a new and returning president.
Indeed.
So just talk to us please about how you see Donald Trump's presidency and him impacting the behaviour of investment portfolios this year.
I'm so glad you opened with a date stamp because things are changing so fast. So we are now at the new dawn, Donald Trump, Mark II, and I want to take half a step back and just go, ordinarily, politics shouldn't materially influence investment until Trump came along. And now we find ourselves in a completely new dynamic where Donald Trump is not following the traditional playbook of statecraft and interacting with other nations. And he has just torn up the rule book, as it were. So there are four key aspects that we're watching at the moment. The first is deregulation, and we expect him to cut through a lot of the red tape, which will be, in theory, highly stimulatory and should also be part of the broadening out away from maybe some of the tech which has been catching the headlines in the recent past. It should be beneficial for things like energy. You can't say energy in Donald Trump without obviously then going the quote that he wants US to be self-reliant on their energy needs, and hence his pre-election campaign of drill baby drill, and that they're going to go back to fossil fuel. So for traditional energy stocks, deregulation, very exciting. Not so exciting for the newer renewables, because Donald Trump is not such a fan of wind, of solar in the same regard. We then look at tax cuts. Now, he wants to stimulate growth. He wants to bring in tax cuts in order for businesses, for individuals to be able to go out and spend and stimulate further economic activity. It's not immediately clear what's going to finance those. He's talked about tariffs, and we'll come to tariffs in a minute, but he's inherited a very large budget deficit, not unique to the US, it's endemic across the globe, but he's going to have to find the cash somewhere in order to make these tax cuts from. But again, very exciting, would be stimulatory to further US economic growth. We then come to immigration, and he's trying to close the borders for what he's obviously referring to as illegal aliens. Difficult to enact. Again, we saw last week he was trying to repatriate a number of Colombians. Colombia wanted to close the airspace. He threatens tariffs. And it's going to be this constant headbutting of different ideologies as he tries to force his way through. Now, immigration could be inflationary, only insofar as the unemployment rate in America is already very, very tight. A number of these workers have found themselves into the workplace, illegal aliens have found themselves into the workplace. If they are removed from the States, who's going to fill those jobs? the employers are going to have to pay more wage inflation in order to encourage new workers to move across, or they're just not going to be able to offer the same goods and services, in which case whoever has survived is going to be able to charge more as a replacement. So there's an inflation angle here, which he needs to be very careful on. And then the fourth is the tariffs. And he came on his pre-election campaign around 60% on China and talking 10-15% elsewhere. Now he's in the White House. That seems to have softened, moderated a bit. He's talked about 10-15% for China in the very recent past, in the last sort of 48 hours. China is retaliating. In the last 24 hours, what he was threatening Canada and Mexico have bought a 30-day sort of pause while they tighten up their borders. They promise not to allow so much fentanyl to come across the borders as well. He's using tariffs as a stick rather than a carrot in order to try and get his positions across. Again, we see this more at the moment as a negotiating tool, but again, just got to be careful because China is about 15-ish% of trade with America. Canada and Mexico materially higher. So if you're going to impose tariffs on Canadian and Mexican goods, that's going to feed straight into the cost paid by US businesses and individuals, inflation. So again, it's a fascinating point in markets. I mean, it's not immediately clear-cut how each one of these four policies that he's come to the White House again on the back of are fundamentally going to play out. And some of them aren't necessarily going to be giving him the outcomes that he's really looking for.
Thank you. Just while we're on the subject of America and kind of interlinked with this, of course, we've got the situation with these 7 huge businesses, all US-based companies known as the Magnificent Seven. And, they are a size now, which means they are, again, hugely dominant. And a lot of portfolios have got a lot of exposure to those companies. So what's your outlook on those 7 businesses? How are you and your team feeling about them? Do you see their dominance continuing?
So these businesses are leading the way in artificial intelligence and the adoption of new technologies, which is going to transform the way people operate around their day-to-day and businesses go about their day-to-day business. We don't yet know the full impact of what artificial intelligence is going to bring, but the early developers, so the likes of NVIDIA, who are making the chips or designing the ability to make these chips, Microsoft with the way they're adopting or an early adopter of the technology and sending that across to us, things like Copilot, everyday use on our Excel, on our Word, on our business suites. They have enjoyed tremendous returns on the back of what might be coming and the increased productivity. The problem is, they're incredibly expensive as stocks relative to their own history and relative to the market. Now that's fine if revenue continues to grow off the back of it, earnings continues to develop. But they seem to be priced for perfection. And everything was fine up until last week. And then last week we had the announcement of DeepSeek, a Chinese competitor coming into the marketplace with an alternate version, if you like, to ChatGPT, but they've developed it at a fraction of the cost. And they're making it open source, so it's accessible to all. Now, from an economic markets basis, that's really exciting because businesses and industries that were maybe a little circumspect adopting AI have now got a really cheap source of artificial intelligence they can tap into and maybe embrace and enhance some of the productivity around their day-to-day business. But for those businesses who have been the early winners, they've invested billions. And suddenly the market's got a question mark. And that question mark is, are they going to get a return on that investment? Because there's a business over here that seemed to be offering a very similar service on a shoestring. So in the round, what does that mean? We've got some highly large market cap businesses in the US which have driven returns, exciting new technology, but the advancement and surprise of DeepSeek has now brought into question whether or not the market should be paying quite such a rich valuation, an expensive valuation for these businesses, which is why we've seen some quite wild swings in markets as the market digests the efficacy almost of the DeepSeek claims. Are they able to deliver what they've promised, and have they managed to do it on that price budget? But fundamentally, it remains very exciting insofar as it's just broadening the opportunity set for everyone to consider how they might now enter the marketplace and embrace this new technology.
So what's the mood amongst you and your colleagues about America as a country in terms of its position and its ongoing influence on investment portfolios, would you say?
So we look at the world through a lens of developed markets, emerging markets. And in a global context, the US is undoubtedly the largest of the developed markets, and developed markets are of a magnitude greater than emerging. So we have to have a view and an understanding of where we are with America because they are so dominant. We got softer economic data week before last on Q4 GDP, which came in at 2.3. Market was expecting 2.6 growth. A little bit disappointing, a little bit soft, but Europe's about 0.7. So US is still the dominant market force. It might not just have been growing quite as quickly as market strategists, economists were expecting. So we don't want to be trying to take a position away from that driving force of developed market growth. We want to be, and we are, neutral on America at this point. But what we've been doing through the course of Q4 last year and continuing today is just very gently tilting our portfolios away from those large cap growth for the richness of the valuations, as we were discussing a moment ago. That was long before DeepSeek caused that additional volatility. Rotating into large cap value, so businesses which could be mature, cash flow generative, but just not in the tech, the artificial intelligence, the markets overlook them, but they're offering good value. So we've just rotated slightly from growth to value, but wanted to stay neutral overall to America. It is still the most dominant of the economic growth in developed markets.
Thank you, Dean. I want to move on now from America and just focus on a little more domestic areas. And without getting into any political discussions today, obviously the Labour Party has now been in government for 6 months, and we've seen some of their plans and policies come to the fore. How are you seeing those policies impact the UK economy and financial markets? How are you seeing both the positive and negative impacts that could have?
So the UK as a market in the global context has been very much unloved for quite a number of years now. It's had slower economic growth than the US. It's got a different construct insofar as the UK market is dominated by older economy rather than the new and the technology. The new administration is struggling to stimulate growth. We've just come off the back of Rachel Reeves' budget, where she was trying to kickstart a little more economic growth. And to be perfectly fair, she's got a real difficult challenge on her hand. That whole administration has inherited a very large budget deficit. With interest rates higher, the servicing costs, the interest repayments on those borrowings is eating more and more of the tax take. The challenge of the policy that they've taken of increasing tax rates, increasing business rates, increasing minimum wage, is that it all squeezes the margin of UK PLC, i.e. the businesses within it. So there has never, and again, this is an apolitical comment, but there has never been in history evidence that economic growth has been stimulated by tax hikes. But we understand why she's taken the policy she has. I mean, she has very few opportunities otherwise available to her. But it's a really difficult tightrope that she's got to now walk between not suppressing businesses and the margins that they need to be able to generate in order to continue to operating, not taxing the individual so much that they become almost disillusioned, worried about the outlook and stop spending. Now, at the moment, the consumer still is in rude health. Unemployment levels are at decent levels. We've had wage inflation. It's cooling a bit, which is good for the inflation number. We're still in a disinflationary environment from that peak of sort of 9% we saw in the recent past. But that inflation numbers, that last mile of inflation isn't going anywhere. So it's difficult for the Bank of England to continue to cut rates too quickly to try and stimulate growth when inflation is stubbornly staying high. But fundamentally, we can understand what the government is trying to do in trying to get those growth stimulations in. So what are they talking about? It's more around the infrastructure. It's more about trying to build, whether it's road networks, whether it's railway lines, whether it's properties, and kickstart the economy through that spending without distorting the natural spend of the everyday consumer. And it's a really difficult line that she's got to walk at this point. Now, the flip side, if I may jump in, UK PLC has been unloved. There are fantastic businesses here. They are on very cheap valuations, certainly relative to the US, but relative to their own sort of 30, 40-year history. If you look beneath the bonnet in terms of the exciting bit here for investors is we are seeing almost record levels of share buybacks. We're seeing ever-increasing number levels of dividends. Now, share buybacks are really interesting in that they are executed by the management teams of the underlying businesses. They're the ultimate insider. They genuinely know the strength of the business. The likes of myself, my team, we're the outsider looking in, trying to make educated guesses as to whether they're operating well. But if the directors of the business are saying, actually, these shares are really cheap, we're going to buy back, that's a really positive statement. We're also seeing private equity sniffing around, trying to find picking up these really cheap values in UK PLC, taking them private, and you don't need too many bids to come, and then we're going to get a reappraisal of the broader market going, look, this is just too cheap. So from an investor's perspective today, we're neutral because of the short-term political challenges of trying to stimulate growth, but fundamentally for a stock picker and an active manager in this environment, it's really exciting.
Thank you. Just on a slightly different point there, obviously the cost of living crisis, the impact on interest rates and inflation over the last 2 or 3 years has created challenges for our lower risk investors. They've had the more challenging time on the impact in their portfolios, and thankfully 2024 proved to be a better year for that category of investors. So with interest rates where they are today, and your comments there about inflation in the UK, what do you see the outlook for our lower risk investors across this year? How are you seeing that?
So it's all about starting point. As we enter 2025, we've had a bit of a recent wobble around bond yields, but you're basically getting around about 4.5% from UK government debt on a 10-year paper. 4.5% return is actually very, very attractive relative to where equities might be looking, again, over what we call the capital market assumptions. What can you expect from the various asset classes over the next 10 years or so? And if your starting point is 4.5%, that actually weighs heavy on equities. So it's actually very advantageous today for those more cautious, those more lower risk investors, given the current starting point. We're also warmly disposed towards corporate credit, which is priced off sovereign. So technical term is spread. You pay a little bit more because it's underwritten by a business rather than the UK government. But again, in an actively managed portfolio, then we believe identifying the right businesses who are cash flow generative, able to service their debt, some really exciting opportunities then. The continuum, as it were, of the fixed interest opportunity set. So you go from government bonds, sovereign bonds, into investment grade, and further maybe towards high yield. But again, we would advocate active at this point purely because you want a stock picker trying to look at the underlying businesses and their ability to avoid default and manage to service that debt. But there's some really exciting opportunities, but in the context that 4.5% is a starting point relative to what you might get on equities, it's harder to justify some of the equity positions than it is fixed at this point.
Thank you, Dean. I'm going to conclude today's update there. I want to thank you for joining us. I want to thank Dean for your time and expertise today. There may be other questions that you've got that we haven't covered today. Please feel free to contact me directly or your usual Cullen Wealth financial planner. And I'm always interested in your feedback on how you feel about these updates. So again, please feel free to bring those to me or your usual contact at the company. Thank you very much.